Howdy, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, October 26, 2022. Starting with our economic release spotlight, I did want us to draw some attention to yesterday's consumer confidence data. We got quite a few important signals out of that data, particularly as it relates to some of our cyclical views and some of our structural views. So, starting with some of the cyclical views, we've had a view that at some point on the other side of the strategic midterm reserve release, which obviously got amplified in the last week or so, we're going to start to see things like gasoline and crude oil bottom. Our friend Bob Elliott on Twitter was posting a chart about how gasoline prices, if you look at the futures market, are actually starting to rebound. And we're actually considering that as an additional headwind to improving inflation dynamics on the here in Q4 and potentially and beyond. Obviously, the game doesn't end on December 31st as it relates to the Fed's fight against inflation. From a structural standpoint, we got a lot of indications that our high probability bear case scenario is actually increasing. The probability associated with that is actually increasing by the data, according to the data. So, just kind of running down some of the headlines from the report. Obviously, we saw the headline. Consumer confidence index. This is a conference board's number. Decline to 102.5 in October. It's the lowest print we've seen since July. But more important, we continue to see a deep and persistent negative inversion in the spread between the present situations index and the expectations index. Now that inversion is getting mitigated at the margin, i.e., the slope of the line is going up. But historically, it's actually the widening of that spread off of a deep inversion that has been a signal for every single recession we have seen in the U.S. business in the U.S. economy since this indicator became active in the late 1960s. We also got another stealth indicator within the context of that economic report. We got the labor differential survey, which takes indices between jobs of plentiful 6 months hence and jobs less plentiful, and we've seen a decline off the cycle peak, the March 22 cycle peak in that indicator of minus 14.6 points. We've never seen a decline of minus 14.6 points on a 7 month duration that has not coincided with a hashtag actual recession. When I say hashtag actual recession, for those of you who are new, and we appreciate you, what we're talking about is a broad based decline in employment, production, income, consumption, the things the BEA looks at to determine an actual recession. Now they're going to come out and tell us we were in recession well after the recession starts. We don't believe it has started yet because we're not seeing that broad-based decline yet. But at some point they will come out, let's call it within the next 18 to 24 months, and tell us we were in recession. By then it'll be too late. Certainly by the time we're in recession, it'll likely be the time to actually be buying and accumulating a risk. But the problem with that is on the way to that process, as the probability is rising, we do not believe that has been fully priced in asset market. So that's where the risk lies. The risk lies in the probability rising. Once we all know we're in recession, that's where the risk to the upside, the right tail risk, starts to matriculate. But for now, we're still focused on left tail risk from a medium term perspective. Getting into my Lombo dashboard, just looking at our global macro, or so just kind of going down global macro. So dollars bullish, not quite oversold yet. Gold, that is still bearish in the middle of the range. 10-year, that's still bullish in the middle of the range. You got about upside to 4.35, downside to 3.84. S&P 500, that's bearish. The range continues to creep higher. We were pretty consistent about, hey, look, when the range is sloping upward, you don't want to be rushing to put on new shorts into that. Give the market some time to breathe. Let these ranges settle out. The new upside to that range is 39.06 here in Longbow. VIX, that is bullish, medium term, bearish, short term. And that bearish short term signal is actually contributing to a falling range on the lower boundary of the probable range for the VIX. So you don't want to be in a hurry to sort of short risk or buy volatility in the context of that. In fact, this Vega compression has been very supportive of flows into equities or flows within the equity market to the upside in price. NASDAQ, that is still bearish, medium term towards the upper boundary of the range. Russell's a little bit closer to the upper boundary, but again, all these risk asset ranges are sloping upwards, so be careful there. One thing we call out is Bitcoin's bearish. This is actually overbought, so even though the range is sloping upwards, you definitely don't want to be chasing Bitcoin here at the higher end of kind of this sort of 20,000 to kind of 18, 19,000 range there. Bitcoin's getting very excited. Had a really latent response. A lot of the response we've seen in equities off the lows of the September CPI release. I think we've touched right around 3,500 on the S&P 500. Had not been priced into Bitcoin. A lot of the gains from 3,500 to, let's call it, what's the last price in the SPY, roughly 38.50. Bitcoin was kind of agnostic to that, and then all boom, all in one day, we sort of see the response to that. So just because we've seen that response doesn't necessarily mean Bitcoin's about to break out into a new bull market. Net liquidity continues to be negatively sloped downward on a medium term perspective, and so unless you have a view on something that's going to happen within the crypto ecosystem that's going to cause Bitcoin and other cryptocurrencies to broadly diverge from macro fundamentals and other macro flows, we certainly wouldn't support chasing the FOMO in Bitcoin here. Shanghai Composite, that is still bearish, getting towards the lower boundary of the range there. WTI crude oil bearish in the middle of the range. Ag bearish middle of the range, and industrial metals bearish still towards the lower boundary of the range. Getting into my global macro dashboard, which sort of amalgamates ETFs across commodities, developed market equities, emerging market equities, fixed income, currencies, U.S. equities, and volatility. There's about 300 different ETFs in here, all sort of representing individual factor exposures, and then we sort all these ETFs by the odds to give you an indication of what's signaling most overbought, and then we'll scroll down and conclude with most oversold to give you, those of you who are trading options, tactical traders, some ideas. Just sort of consider this like the idea generation portion of the show, where we're trying to just help you find ways to make money. And augment your investment returns and your trading. So most overbought this morning at Australia, the EWZ ETF. Certainly not a place we would be allocating assets to at this point in the cycle. Emerging market dollar debt is actually doing quite well. You're seeing dollar weakness on a immediate term basis is contributing to this as well, in terms of the market repricing the borrower's ability to repay the actual credit. Consumer staples, first S&P sector to get overbought, but again, that upwardly sloping trading range is not something you definitely want to fight as an investor. Again, we talked about this in our lead off morning note, but some of the crowding signals that we're generating in our model, and I won't be specific for those of you who do not subscribe, but some of the crowding signals in our model are kind of supporting what the upper boundary of these ranges are kind of signaling in terms of what to do from a risk management perspective in your portfolio. And then you can signals in things like RSP, which is the S&P 500 equal weight index. And then scrolling down, what's most oversold today? You're seeing a couple of volatility ETFs here, VIXY, the VIX short-term VIX futures, breaking down towards the lower boundary of the range. But again, it's negatively sloped range, tells you that the momentum can actually contribute to further upside. And it's not clear that those signals and other aspects of our process at 42 Macro have been fully resolved in support of these short-term movements. So just be aware of that. We'll certainly signal that to subscribers when we get the sort of all clear signal that it's safe to be a bear again, a raging bear again. So until then, I'll catch you back here tomorrow, same time on the same time, same program, same network. And by the way, if you like what we're doing here, feel free to share it with your friends on social media. Hit the subscribe button, hit the like button. Obviously, we don't ask anything of our viewers and our broader following from Team 42, but we certainly appreciate all the support that we get from you guys. So it certainly helps at the margin. So we appreciate you. Cheers.